Hello and welcome to another video from CEF Mastery. In this video we are going to look at the events that have led to the recent near 60% share price collapse of the closed-end fund FCO and whether there was indications that trouble was on the horizon. First we are going to look at what went wrong, then we are going to go over what we know so far about the fund's upcoming reorganization, or if there's going to be a reorganization happening at all. And then finally, we are going to address those that are known as hodlers, an acronym HODL, which stands for Hold On for Dear Life. Now, before we dig a little deeper, first I'll start off by saying that events of this magnitude do not happen overnight. Often I'll read commentary and message boards from investors who get blindsided from events such as this and feel as though they've been burned by a particular stock or fund, then are quick to call for management to be sued or arrested. But what if I were to tell you that investors bear some of the blame for what happened to FCO? Would that surprise you? Dramatic negative developments, as is the case with the fund FCO, were years in the making. And even though there were plenty of signs that the fund was on a downward slope, investors kept bidding this fund up. Investors that purchased shares of FCO back in April this year of 2025 after the pullback from the tariff announcement probably felt like they had found the goose that laid the golden eggs. Since their investment back in April, they have seen their share price grow just over 20%, in addition to the generous 14.6% yield on costs that an investor would have purchased into back then. One common and very dangerous error I see new closed-end fund investors make is that they'll base their purchasing decision almost solely on the consistent payout history, assuming that's an indication of a strong fund. But what they do not realize is that when investing in a fund with an aggressive distribution policy that is unsustainable, while they assume the distribution payout is safe based on previous payout consistency, they fail to realize with each consistent payout, the closer it is to the inevitable distribution cut. The only question is how big the cut will be and what impact it will have on share price. What we're going to do a deep dive into the fund FCO using CEF Mastery and examine if it were possible to spot trouble long before the inevitable eventually happened. First, let's start with the fund's score history. Since closed-end fund Mastery started keeping score on FCO back in 2019, FCO never particularly scored well within closed-end fund mastery. Lower scoring funds within closed-end fund mastery, as you see here with the fund FCO, are considered riskier. The lower the score, the more likely the fund is to encounter distribution cuts and capital deterioration, also known as NAV erosion. One of my favorite indicators in the score history chart is the number of distributions remaining, indicated in this chart by the black line and the black numbers. The number of monthly distributions remaining is the lifetime accumulated earnings of a fund divided by the distribution to determine how many monthly distributions a fund could make before having to seriously consider cutting their distribution. This metric, while simplistic in nature, cuts through all the noise: rights offerings, reinvested distributions, reorganizations, etc. In a healthy fund, this number is usually above zero, indicating that there are some accumulated profits post-dividends. When this number is in the negative, as you see here for FCO, that means the fund has no accumulated earnings and is forced to rely purely on income captured in the period and or return of capital to maintain their distribution, else amass more losses. In the absence of accumulated earnings, the behavior of the fund that caused it to go negative in the first place, the common culprit being paying more in distributions than it is earning from income, will likely continue absent a distribution cut. The result being a further decline in accumulated earnings, which is in fact accumulated losses and or a forced return of capital. Return of capital is not a bad thing. It offers tremendous tax benefits. But when return of capital is forced in the absence of a distribution cut, it's a good indicator that things are going to escalate negatively. If you look at the number of distributions remaining for FCO in the score history chart from the period of September 2022 to present, the number of monthly distributions remaining, while still negative, has improved significantly from negative 45 to negative 23. So if the fund's accumulated losses are narrowing, isn't it possible that given more time, the fund's accumulated earnings could go positive? It doesn't matter. The distribution is too big of a burden for the fund. Here in the bottom right-hand corner of your screen, we have listed for the fund FCO, listed in the blue box, an annual average return of capital of 75%. Exit the ROC portion of the dividend, that leaves an estimated 6.91% of the total distribution that comes from earnings. You can see that number indicated here just to the left in the green shaded box. So for example, for the fund FCO, after the market price decline, FCO's yield has spiked to 27.72%. Based on the current market share price of $2.89, of that 27.72% yield, only 6.91% of the yield is from earnings. The difference between the stated yield of 27.72 and the earnings portion of the yield of 6.91 means the remaining 20.81% of the yield is return of capital based on the annual average 75% return of capital. For a fund having to rely so heavily on return of capital to keep the distribution intact, it's only a matter of time before something irreparably breaks. But until it does, what is a fund to do? Raise more capital? If we go to the fund's alert history page, we can see that at 3 separate occasions, back in October of 2021, October 2022, and October 2023, the fund FCO made 3 separate attempts at raising more capital using their ATM facility to increase investment income. You can see that here, here, and here, where each use of the ATM facility gave an initial boost to income. You can see that with the little spike in income right here, here, and here. It narrowed the accumulated loss, but all 3 attempts failed to turn around the direction of the fund, and the accumulated losses resumed. In November to December of 2024, FCO did get a much needed boost in unrealized appreciation, which narrowed the accumulated losses even further. But it was nowhere near enough to help support the distribution payout of $11 million plus. Then by the time FCO next reported in April of 2025, all those unrealized gains vanished. Over the last few years, a 75% annual average return of capital in the absence of a distribution cut has put continuous strain on the fund's net asset value. At no point in time, going back to August of 2021 and possibly sooner, did FCO enjoy an increase in net asset value. There was a slight head fake after the bear market in 2022 when NAV turned up slightly but almost immediately resumed its downward trend. Market, however, bought into this little head fake hook, line, and sinker as investors piled into this fund, bidding the market price up higher and higher, which created such a massive divergence in price from its NAV until the recent crash created a premium on its shares reaching almost as high as 116%. That's insane. So if shares were fetching such a high premium, why didn't the fund just sell more shares using their ATM facility? That's a good question. Let's see what the fund has to say. In the bottom yellow highlight over the page, over recent years, the acquired fund's assets have declined due to broad market conditions and a high level of distributions, including return of capital. Now, there are 2 specific points mentioned here: high level of distributions and return of capital. These are technically one and the same, since the high level of distributions were the cause of high levels of return of capital. I try to make this point time after time. There's nothing wrong with an overly aggressive distribution that always results in return of capital. But if the distribution is too aggressive, well, that's why we are here discussing FCO's conclusion. To continue the quote, these factors have led to an increase in the acquired fund's total expense ratio. In addition, the acquired fund's share price continues to trade at a significant premium to its net asset value per share. Management believes this premium is unsustainable as the acquired fund cannot continue distributing at current levels while remaining viable. Now, regarding the expense ratio, that is likely related to the anticipated decline in future asset values from aggressive distributions and the aggressive return of capital were the fund to continue. Both would increase the debt ratios, which would also inflate the interest expense ratio. The rest is self-explanatory. The market is paying too much for their shares, and they're paying out too much in distributions. So what happens now? The goal is for FAX to acquire FCO. The reorganization has been approved by the board, but not by the shareholders. Is the reorganization expected to be taxable to the stockholders of the acquired fund, or FCO? It is expected that stockholders of the acquired fund will not recognize any gain or loss for federal income tax purpose as a result of the exchange of their shares in the acquired fund for shares of the acquiring fund. However, if the reorganization is not consummated, FCO will promptly cease investment operations and will not engage in investment activities except as necessary to effect FCO's liquidation. Should the fund liquidate, it will be a taxable event resulting in gain or loss depending upon a stockholder's basis in the shares and the amount received for those shares in the liquidation. This is where the annual average return of capital of 75% a year could be problematic, depending on how long someone has held their shares. For shareholders of record as of September 11th, 2025, they will be asked to vote on the reorganization on December 10th. But for many, it doesn't seem to matter. Regardless of how shareholders vote, it doesn't appear that investors are waiting to find out. Since the proposed organization was announced, average daily volume spiked significantly from 30 to 50,000 shares daily to over 200,000 shares daily, and investors are still selling. By the time December 10th rolls around for the vote, there may be so many absent votes that the reorganization may go through simply because those that sold recently, while still being able to vote, will have moved on, and by default, the board wins the vote. In conclusion, the major takeaway from this video should be that a fund selling at a premium doesn't equate to premium performance. Among all high-yield closed-end funds, for the 3-year and the 5-year annual average with reinvested distributions, premium funds only outperformed by a little more than 1%. That's not enough for a decisive victory and could easily flip the other way. For the 5-year NAV price change, the results are a little more decisive, with discount outperforming premium by about 8%. When I first developed closed-end fund mastery, it was meant to be just a tool. A damn fine tool, but a tool nonetheless. I refrained from making outlandish claims and make no guarantees because I think CEF Mastery's record speaks for itself. But over the years, after speaking to so many members, I've long come to the realization that CEF Mastery is more than just a tool. For many, CEF Mastery has become a lifeline to a secure retirement. In that spirit, I would like to address a serious situation that I've encountered over the years, and I'm sure you've seen evidence of this yourself from time to time. Recent events surrounding the fund FCO has brought this concern front and center because I'm certain that some FCO investors find themselves in this situation right now. From time to time, when discussing a high-yield issue, I'll encounter a post in a message board along the lines of, "I don't care how much ROC, as long as it keeps paying the dividend, I'm going to hold until I die. After that, it's not my problem." Then jokingly or snidely, someone will reply, "Send me your money and I'll charge you a small fee to send you your own money back." The fundamental flaw in that line of reasoning is this: what do you do if you outlive the fund? On that solemn note, if you liked the video, please like and subscribe to the channel. If you would like to learn more about CEF Mastery, I've left a link in the description below. If you're wondering why you're listening to a guy that has only posted 3 YouTube videos, I would like to take this opportunity to point out that I do have another YouTube channel that I was recently locked out of by YouTube after it reached 1,000 subscribers. I am not yelling foul play committed by Google or YouTube. Someone tried to hack the backup email account associated with that YouTube channel, and as a precaution, Google logged out the account. But since the email was hacked, I'm no longer able to access the channel. However, you can still watch the videos posted over there. There's a lot of good ones. I'll also include the link to that channel in the description below.